voice of the conversation today. Ann Sonders is the chief investment strategist at Charles Schwab. Joining us once again, Ann, it's good to see you again.
Hi, guys.
I hope you've heard our conversation.
Yes.
And from your vantage point, give us your view.
So we actually just published our 2019 Outlook summary today and have the view, much like Paul Tudor Jones, and it's always comforting to have somebody like that in a similar camp, that we are likely to see a continuation of this volatility. I actually think the range could be a bit wider than up 10, down 10. You guys were just talking about earnings and the relative health of balance sheets. The one thing I'd say about earnings is if you think about path of least resistance relative to where they are right now and expectations mid-single digits, what we haven't yet seen is any kind of significant haircut to energy and energy-related sectors for the collapse in oil prices or to the export-oriented companies for the strength in the dollar. And unless you see a reversal in those two things, I think the path of least resistance is down on earnings, which makes the possibility of an earnings recession higher than an economic recession in 2019. But we know what happened when we got an earnings recession for 4 quarters from the second half of 2015 to the first half of 2016. We didn't have an epic bear market, but it was ugly nonetheless.
Do you worry that we are about to enter a more prolonged bear market, right? We've had a rolling bear market of the year, undeniably so. Not that the S&P is down 20%, but there are a whole lot of stocks within there that are down by that or even greater amounts. What does that tell us?
Well, since October, you're somewhere between, 45, 48% of the S&P is down in bear market territory. And to your point about stealth rolling, rotating bear markets, we've seen it across asset classes. In this environment, as global liquidity tide is going out, there's a necessity of repricing asset classes. Now, whether we can continue to do it on a rolling basis as opposed to taking kind of the whole thing down, the major indexes down, I think that's a function of a couple of things. One, what the length of runway is between now and the next recession. I think a needle mover there will be trade. If we don't get an agreement on trade and we go to the full 25% on the total amount of imports from China, then you're talking about more than a percentage point off of GDP. And if you're back into trend-like growth next year, that's a pretty big hit. And that 1 percentage point is just the math of the tariff amount divided into GDP. It doesn't consider the ripple effects, whether it's through the confidence channels or through the CapEx channels, which you already talked about, and through the inflation channels. So I think you have to add to that 1% too if we don't get some sort of agreement on trade.
Lizanne, it's Jim. Good to see you as always.
Hi, Jim.
I want to talk about something, your analysis on the GDP growth, totally spot on. I want to talk about something Lee Koopman talked about last week, which is basically, you could distill it to meaning, what happened to the SEC as a watchdog for not only for the individual investor, for someone who wants to buy stocks and is really frightened out of it? Why do we not reconsider, say, the uptick rule? Why are the institutions not clamoring for what Lee said? Because it would mean more money in, theoretically.
Yeah, I can't get inside the head of the SEC. I think a lot of the regulatory changes ostensibly to the benefit of individual investors in terms of just the information flow and the inability for analysts to get, prime data before the rest of the public. But I think the bigger problem is that the mechanics of the market and the machine-driven trading has just meant it's a much more difficult playing field for individual investors. Our message has been, don't try to shorten time horizons to nanoseconds and attempt to play the same game as the algos, because that's a losing proposition. Lengthen time horizons. But whether the regulatory bodies, SEC or otherwise, could try to help with things like the uptick rule, unfortunately, what we have seen is you tend to have to go through pretty significant eras of carnage before you get the adjustments that probably should have come in advance. But we think it has become a more difficult environment for individual investors. And as much as they think that suggests they have to take more of a trading approach, we think that's going to be to their detriment, not to their benefit.
Yeah, Joe mentioned, money flying out of mutual funds. I mean, the individual investors clearly had a little bit too much turbulence for their appetite. You think a rate hike next week is a formality at this point, or do you think that's slowly going to, or it has to be quickly, I guess, since it's next week? But if the market continues in this kind of upset, how do you think about the Fed?
I think the market, although, I was at the Economics Club in New York lunch at which Powell spoke, and in addition to the things we've all talked about and looked at and the implications for the market, I do think one of the things he said was important, which is that financial market volatility alone isn't going to be a decider for them. It's financial system stability. Now, whether enough volatility and enough weakness kicks in such that they view financial system stability as at risk, I think December is still a pretty high likelihood. But the idea of even one next year is a foregone conclusion. I think that is much more in question. And I believe even the futures market as of today doesn't even have a full single rate hike priced in for 2019. We've had one or two with perfect willingness to back off that depending on the data. But I think December, unless we really see the market come off the rails between now and next week, is probably still going to happen.
Lizanne, we thank you as always for your time.
Thanks, guys.